Let me now bring on board Sanjay Sinha, founder of Citrus Advisors. Morning, Sanjay. Welcome to ET Now. Sanjay, do you think Indian markets currently are stuck between rock and a hard surface? Locally, we've got event risk. Globally, things are looking twisted. Risk off trade seems to be starting. Global volatility has shot up, and crude certainly is trading above the comfort zone.
I think what has happened is that, all of a sudden, all the negatives are staring us in our face. And that has happened in a background where, we had come to a threshold of almost 5,700 points of the Nifty, and we were extremely bullish on the market. Whatever has happened on the political arena, in my opinion, is actually, apart from the impact that, it is perceived to have on policy, it has at least sobered down expectations running up to the budget, which historically, if you go and see as to how the markets have normally behaved, whenever you have approached the budget with a lot of expectations and the markets have actually rallied before the post-budget markets have actually been a disappointment. I think the fact that we have had sobering influence on expectations, the fact that we are approaching the budget not only with a sense of caution, but also with a sense of apprehension, I think has set a good ground in terms of how to approach the major policy announcement next week. But more than that, Nikunj, my personal view is that it's not necessary for the government to have a majority or, for that matter, a very large mandate to take reforms forward. If you see the reforms in India were actually started by the Congress government when it was running a coalition. If you look at states, Bihar started the reform process when it was running a coalition government. So I think this fear that the government will become populist because of the mandate in UP, in my opinion, is a little unfounded. I think on the contrary, we might actually find the government to be on the front foot as far as reforms are concerned. And that might actually be a very pleasant discovery for the market, and you might see a rally.
So Sanjay, are you not of the view that the macros could strain from here onwards, reforms may stall and capex may only slow down?
See, what has happened in the last 18 months is not so much a mismanagement of the economy. I think there has also been fair amount of mismanagement of the politics also. If you see the way the government went forward with the announcement of the FDI in retail and then had to backtrack, I think there was no error in terms of the intentions of the government. But sometimes you need some good politics to drive some good economics. The fact that today you have a situation where the government clearly understands that it doesn't have a very clear endorsement or support of its coalition partners, as well as the fact that in the federal structure that exists in India, the state governments are also becoming quite vociferous. I think there would be a fair amount of politics which would precede the actual announcement of an economic reform or the actual implementation of the economic reforms, which I think is the need of the hour today. Secondly, the fact that in UP we have seen a government being voted out of power because there were controversial issues related to corruption and other such areas, I think that would bring about certain amount of cleansing as far as the governance in the country is concerned. So if you move a little back from the knee-jerk reaction that we have given to the poll verdict in UP, I think the ground reality might actually be very different. The second issue that you raised about the capex and the spending on that, I think if you see, if I was in the government, 2012 is the last year in which I can flag off projects which I can showcase in 2014 when I go to elections. So in that background, if they don't seize the initiative now, I don't think they will get a second chance. And therefore, if you see what actually happened in the state elections, instead of doing some preparatory work before the election campaigning, all the focus was only on the election campaigning, and that didn't work. So I think the message is very clear. The electorate actually wants to see visible manifestations of progress and not just words in that regard.
Sanjay, you and me can endlessly talk about the reform process, valuations, what we should expect from Reserve Bank of India, and what is in store for us from Union Budget 2012. But the bottom line here is that Indian markets this year have appreciated because of global liquidity, and globally liquidity is now threatening to reverse. If I map how foreign institutional investors have moved in the month of March, the flow is drying up. Globally, risk on trade seems to be reversing. Crude is threatening to, create an havoc, and Dow is struggling to stray above 13,000.
So if the central proposition is that whether liquidity will keep coming to India, I think on that count, look at what happened in 2011. 2011 was a year in which the macroeconomic picture in India became from bad to worse. We had an interest rate environment which kept on going up. We had inflation which was going up. In such a negative environment, all that the foreign institutional investors took out from the country was roughly about 4,500 crores, less than $1 billion. In an environment where the interest rate cycles are peaked off, an environment where there is now a compulsion on the government to come on the front foot as far as reforms are concerned. Now, why should the FII stay away from India? As it is, the exposure that they have to India is very low. Thirdly, on the issue of liquidity, I don't think the liquidity is drying up in the global markets. Actually, with the last ECB infusion of liquidity, that's now a worry that liquidity is going to be sloshing around and therefore chasing risky assets which may find its way to emerging markets and particularly to India. So I don't think we have a reason to be extremely apprehensive as far as liquidity is concerned. But if the government ends up mismanaging 2012 as it has done 2011, then of course you could have a ground to have that fear that liquidity would not be supportive of a rally in the markets in India.